Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the early running, the earlier than usual Bull versus Bear webinar, 15 minutes earlier than usual. The Bull versus Bear webinar here. Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go for our usual regular run through in here today. We're going to look at the calendar, what we've had, what we've got coming up, what are the major. Let's take a look at the major geopolitical, but more importantly, macroeconomic and fundamental events that are impacting markets right here, right now. And then we'll take a look at the charts, see where the opportunities lie today. So, although front and center is obviously the reaction to the Fed, which was clearly important, we had central banks involved all over the place in the last 4 to 36 hours. So yesterday, if you remember, the ECB, the European Central Bank, held an emergency meeting because European peripheral bonds, that's so the periphery of Europe is outside the core, and the core is deemed as really France, Germany. And then outside of that, the peripheral bonds, most notably Italian government bonds, a bit have sold off with since the ECB meeting last week. All government bonds, European government bonds, have been selling off. In fact, global government bonds have been selling off with the more hawkish tone anticipated from global central banks, from the Fed, and because of the high inflation numbers globally, and particularly the CPI, the US CPI numbers. So we've had global bond markets selling off. That's going lower price, higher yields, higher longer term interest rates, completely expected. But European government bonds have been particularly selling off even more aggressively because the ECB pivoted to that slightly more hawkish tone, which we'd anticipated, right? And then what we're seeing in here is then since then, the peripheral bonds have been really getting hit, and that's a real problem, particularly for those economies on the periphery whose now government bonds are trading at much higher yields, and that puts them under pressure. Okay, and because that's putting them under pressure, the ECB then stepped in yesterday, and they didn't actually announce exactly what they're doing, but they're going to put something in play. And there's a lot of conjecture, a lot of rumor about what they might put in play. But what they're trying to put in play is something to help out the peripheral bond market. Okay, so we're going to certainly, and that's been a major development, which was even before the Fed yesterday. I'll come to the Fed shortly. But I just want to put out another couple of things that have happened this morning in the European time zone. You guys know what's happened with the Fed, right? You were probably there sitting there trading, I hope, live. However, what we've seen since then is we've had the Bank of England, okay, which was kind of came in as anticipated. So the Bank of England raised rates by 25 basis points. Now, the Bank of England, although they haven't raised as much, they haven't done as big a rate rises, they were actually in play before the Fed. Their liftoff was the end of last year, ahead of when the Fed lifted off. So the Bank of England have been trying to get ahead of the curve. They raised by 25 in here, and we'll see in here on this Twitter feed. So 25. As kind of expected in here. 6 policy members vote for 25, 3 vote for 50. Haskell, Mann, and Saunders voted for the 50. That was kind of expected as well. We did anticipate the vote to go that way. Okay, so so that's nothing that's too surprising. If we actually look at the impact of market on the Bank of England, it's not been that significant. So this is the cash market for the pound versus the US dollar in here. And you'll see in here pound versus US dollar, we've seen a sell-off in here. So this is on a 6-hour chart. If I go to the 15-minute chart, you can see that's since the announcement. Boom. But it's not a big drop in here, but nevertheless significant enough in here. About a cent and then rebounded since then. So it's dropped about a cent. So that's like a notable move in here from like it was trading around 121.50 and it dropped down to like 120.50 and now rebounding a little bit. So it's not in the grand scheme of things, if we look on like a daily chart in here, it's not a huge move down, considering where we rebounded yesterday. But nevertheless, we have seen some price action there. So that's kind of as expected. And if anything, now, if we go back to the article in here, where are we? Bank of England in here, it said is ready to act more forcefully. Okay, so ready to be more hawkish. Okay, so if anything, a slightly more hawkish tone. So the bank said it was ready to forcefully stand back Danish post-war inflation rate heading above 11%. So that's another development. Now, the more shocking, the surprising development is that the Swiss National Bank in here, the SNB, which we don't usually focus on, it's fairly dull as a national bank in here, central bank. But if we go and take a look at the calendar in here, you'll notice So the previous rate was so they got negative interest rates. So we got negative 0.75, and they were forecast to leave their rates unchanged at negative 0.5. They actually hiked rates by half a basis point, half a percent, 50 basis points to now still negative minus 0.25. But that was a surprise hike, and that has had a negative impact in here on European stock indices. So look, European stocks hit by surprise Swiss rate. So that hasn't helped matters as well. Stocks were already selling off this morning in Europe and the US futures ahead of that, as markets have digested, as they've come to terms with what the Fed have done. And that brings me nicely back to the Fed. I mean, before I actually go to Fed, let me do the calendar quickly. So SMB, we've spoken about the Bank of England raising rates in line, but slightly more hawkish in here. Looking ahead to the US today, light on data. Yes, we have data, but none of this is impactful data, in my opinion, right? I've been doing this a long time. Housing starts, building permits, jobless claims, which is weekly data, Philly Fed. These are important, notable pieces of data, but in the light of what's going on, bigger picture in here, not that important. What's probably more significant is, given we've had now 4 central banks in play in the last 36 hours, the ECB a surprise meeting, the SNB, the Swiss National Bank, a surprise rate hike, and the Bank of England delivering what was expected, shifting more hawkish, and obviously the Fed, which I'll come to, over the last less than a week, pretty much since Friday's CPI data, and really the acceleration was on Monday, the market went from pricing in a 50 basis point hike to a 75 basis point hike, and the Fed delivered the 75 basis point hike. So a real tumultuous kind of 36 hours for central banks, really. And we had the Bank of Japan. Now, the Bank of Japan, as I discussed on recent webinars, have been and stayed uber dovish. There was an article I shared yesterday, we looked at yesterday, about the real risk in here to might have been the day before, and I've been thinking this for a while, okay, and I think there's lots of people thinking this as well. There have been some big bets put on by hedge funds that to try and break the Bank of Japan, to push them, okay, to actually move away from this uber dovish, uber easiness on monetary policy that they continue to have. That they've had in here, to be quite, most of my career, and that's a long time, right? Since certainly the late 90s, not all of my career, but certainly since the late 90s, they've been in what we call a zero interest rate policy, environment, way before we had all of the zero rate policy that we saw after the global financial crisis. But all the other central banks, they were doing quantitative easing since the late 90s and continue to do that. They continue to support Japanese government bonds, JGBs, okay? They keep them artificially high in price, and so yield doesn't go below their set yield levels, okay, that they have. I think it's 1%. It's either 1 or 1.5% on the, I can't remember the actual level, on the 10-year JGB. They won't allow them to go through that level, right? They're aggressive buyers every time it moves to that level. There are lots of bets going on with hedge funds. They're trying that maybe they might relax that. Now, I'm not saying they're going to say that and they're going to relax it. They're not going to be hiking rates. They still have negative interest rates here, minus 0.1%. I'm not saying they're going to do any of those things. They may, though, step. There's inflation around the globe. There's inflation in Japan. They may step away from this. They may hint they're stepping away from it. And that will be another major global, after really the Fed, the second biggest, arguably the ECB, the second biggest, but one of the major global central banks in here stepping from a super dovish position, potentially to hawkish. So this is going to be important, okay? Late, so very, very late in it's actually like, my morning, very late in your day in here, 11 p.m. Eastern time. But it might be something worth watching in here. It could have an impact on global markets, right? Let me move on to 5 things you cited today. Right? Market mayhem, markets on the back foot again. So even though stocks managed to rebound, if you go and take a look at my technical analysis that I wrote last night, only just over 12 hours ago after the US closed, they look like we got a little bit of a rebound in stock indices. They seem to do enough in here to say, okay, we might be putting a little bottom in. The risk was we're consolidated, having had a big plunge lower again on Monday. We kind of consolidate, went slightly lower Tuesday, consolidated Tuesday through Wednesday, and then Wednesday after the Fed, we got a slight rebound, not a big rebound, but enough to hint on the Nasdaq and on the S&P that we had some bottoms put in. Some of the European stock indices, the FTSE notably, look like they're putting in some small bottomings positions, and we'll take a look at that when we come to the charts on the Nasdaq and the S&P. However, that's been wiped out in overnight activity. European stocks significantly lower, not helped in here by the SMB, the surprise rate. They've even got it on their top here. Look, the Swiss franc gained more than 1% against the dollar after the Swiss bank surprise with an 8% rate hike. Okay, so they've even put it in their top paragraph in here. It was a surprise, and that hasn't helped. European stocks this morning were already pushing lower. Let me just check the timing on that SMB. So they were already lower. When I woke this morning, very early my time, European stocks have already been selling off in the late Asian session, pre-European open session. Okay, in here, so pre-European time, pre-7, 8 a.m. in the morning, the late Asian session. So stocks were already lower. Stock futures, the US stock futures were already lower, and this morning's SMB rate hike hasn't helped that. So a real kind of once the market had kind of digested the Fed, overnight Asian stocks didn't necessarily like it. So all of this, they're pointing out recession risk. The market is thinking maybe it's too late with this more aggressive rate hike, and the rate hikes they're going to have to continue in to do. Look, America's worst bond market collapse in at least half a century. Okay, so the bond market's selling off aggressively in here to lower prices, higher yields, and then now the Fed's, saying they're expecting a median expectation of 3.8%. Previously was expected at 2.8% by year end, the benchmark rate. Okay, it may take a recession to stamp out inflation. It's like to happen on President Joe Biden's watch. Okay, so again here, look, they're covering the surprise rate hike in here from the SMB. Okay, and the Bank of England. This was before obviously they hiked, but they've hiked again in here today. And then also pointing out, look, the Bank of Japan is unlikely to let any policy change at its meeting, even as the yen trades near 24-year lows. So dollar yen at a 24-year high. We mentioned that the highest point this century, took out a peak in here from 02, highest level since 1998 for dollar yen. That's yen weakness in here. So even with the weak yen, the Bank of Japan not going to probably change anything, but I would not be surprised if we get a hint of something. So just watch out for that. Crypto getting crushed again, risk off. There's a positive correlation. They're moving the same way. Risky assets and crypto markets in here, and crypto is going through lots of other woes in here. Celsius in here. There's also the 3AC. That's right, 3AC I think is a hedge fund under pressure. Rumors of that huge hedge fund that invests in crypto assets in here under pressure, and all of that very negative. Bitcoin got very, very close on the futures market to $20,000. A break of $20,000 would be a significant negative for the crypto market. So just watch out for that as well, because that could have a contagion effect into the stock indices as well. Okay, so not good on the crypto side. We've already spoken about the tweet there. I've spoken about the SMB, I think. Yep, SMB, Bank of England we've already covered in here, and then just going through really the Fed. Powell sets path to restrain the economy and stop runaway inflation, suggests avoiding recession may be out of Fed's control. So almost yesterday, Chairman Powell effectively said there's a really good chance of a recession. He didn't say it, he's not going to say that, right? But he's acknowledging that that's a real chance, and they can do little about it because they've got to keep inflation, they've got to get inflation in check. Fed rolls out biggest rate hike since 1994. They haven't done a 75 basis point rate hike since 1994, and the economy is also slowing. Again in here, this is the overnight stocks Treasury slide. So Treasury is back lower in here. Let's go and look at the Treasury yield in here. Look. This is the yield. This is the cash market in here. This is the Treasury yields. So, having surged higher post the CPI data. CPI data comes out here. The market surges higher up above the recent yield peak at around 320. We got up to pre-Fed in here, up to 350 in here. And then after the Fed, the market did get a move back lower in yield down to like 325. But already today, we're back up to like 346, okay? And threatening the peak that we've seen recently. Up through 350 would be certainly a negative for stock indices, okay? So bond markets pushing lower in prices. This is the yield chart. Back higher in yields. Where did I get up to here? Stocks Treasury slide as recession fears return. Fed-driven rally fizzles. So we did get a rally yesterday. It did look like bases were going in, but a fuller assessment of policy paths. So overnight, markets taking stock of the Fed rate hike and worried. Futures slump as recessions fear loom. Also, the oil market, because obviously, and this is potentially signaling U.S. economy. What's the market saying? The U.S. sneezes and the global economy catches a cold, right? So U.S. economy sneezing, potential recession, and the global economy catches a cold, the global economy gets worse. and then that puts less demand on commodities, less demand on oil particularly. So the oil price has gone lower in here. So that's kind of positive in some ways for the inflation outlook, but nevertheless, certainly a negative. WTI down 5% in the last couple of sessions. And if you go and take a look at my reports, it does look like WTI does look like the oil future in here is put in a topping pattern and does look more negative for a deeper correction lower, in my opinion. We can take a look at the chart on that as we go forward. Oil prices forward, US rate hike, but tight supply still in focus. What else we have? Russia gas flow to Europe falls, so that's not a good thing in here, particularly given we've got European gas prices have surged over the last couple of sessions because of problems in the supply from the US, and also then Russian gas flows to Europe falling as well, not helping matters there. Let's take a look at what we've got in here. So a massively negative day in here. The combination of the failure after the initial rebound, the failure overnight in here, as the market has reassessed the Fed rate hike. European bourses look down between 2.5% and 3.5%. A really negative day for European exchanges. And we look at where we are this morning in here, having had a rebound yesterday of 1.5% up to 2% in here for the Nasdaq. We've given all of that back in here, so we're down there. The Dow 2%. The Nasdaq 2.33%, and the S&P 2.33%, and the Nasdaq coming up that 2.8, nearly 3%. Let's take a look at the Fed tool. What's the Fed tool telling us in here? The interest rate curve, the futures curve, 85% chance now at the next meeting, the 27th of July meeting, of another hike in here. Now they've set the standard with only a 15% chance of only going 50. And if we look further out now into September, what we're pricing in is the greatest chance now of 275. So that is up a 75 and a 50. So looking for a 75 and a 50 there. But, chance in here of 275s as well. And if we look to end of year, somewhere in here now, okay, which is what the Fed are telling us anyway. So 75% chance of between 200 and 2.25. So that's 2 to 2.25% of rate hikes, further rate hikes between now and the end of the year. We're currently seeing at 150, okay, and so that's the potential in there. So up to 350 to basically 375 in here. So that's another between 2% and 2.25% is median forecast in here by the end of the year. Okay, so certainly a really more aggressive stance being shown in there by the interest rate curve. Right, let's take a look at some charts. So there's the S&P, tells you it all. There's the rebound, the small base potentially, and look, we've already hit a new low in here this morning. And if we go and take a look at the 15-minute chart, you can see why initially it looked like a small base in here. So this was yesterday. There's the Fed, right? So very erratic, whipsaw price action. It spiked higher, then significantly lower, then came back all the way higher. And up here, around here, there's the close. Okay, so there was a close, a healthy close up here, right? And it took out all of these peaks, peak, all of these peaks in here. This looks like, when we had just this price action up till today, this looks like an inverse head and shoulders, right? You got like double shoulder over here, you got double shoulder over here, you got a head down here. You could argue it's a double bottom with these two lows, but it's more like an inverse head and shoulders, right? With the neckline, arguably like across here, right? This is like an inverse head and shoulders. Okay, yesterday as it sprinted through here, like shoulder over here, or two shoulders, shoulder, head, shoulder, double-shouldered head and shoulders, inverse head and shoulders, pointing higher, and then boom, the market wants nothing to do with it. This is the Asian session. As we go into the Asian session in here, through the Asian session, up to here, and then this is the European session. So it was already negative up to the Asian session. As we go into the European session here, and then European session, we get the rate hike from the SNB, and then boom, even further lower. And now we've consolidated over the last couple of hours. As we go into the US Open, still looking very negative in here. You'd have to say, this bounce, it'll then look like a base now, looks like what we call a dead cat bounce. You go back on the daily, it looks like a dead cat bounce. Like bounce, boom, right? Back lower, dead cat bounce. Why dead cat bounce? Dead cats don't bounce, okay? So in here, market looking really vulnerable in here. As me, I've got a natural bullish tendency. There's no bullishness around this. You had a potential inverse head and shoulders. You had a potential bullish statement. You had a major event. The market seemed to make a positive statement on the major event. Even after this whipsaw price action, and there's the close. The close is right around here, right? Even after the market, this whipsaw price action, the market close. We then get post close going into the late, the after hour session. The market even managed to rally back higher. And then what do we get in here? Then the market completely capitulates overnight and goes to a new low. Super negative going into today. It doesn't mean it can't turn around, so don't get too tired to positions. Surprisingly, the Nasdaq, right, which has been the leader on the way down in a lot of ways in here, has actually slightly outperformed. It was a better day on the top side yesterday, and it wasn't we've not undercut Tuesday's low yet. Right, so we're actually holding above Tuesday's low. I mean, it still looks a disaster on the chart, but you'd argue that this is a better base. Look, there's the bottoming pattern, the same bottoming pattern, and the Nasdaq goes all the way up here. So it's a much better rally in here by the Nasdaq. However, again, look, boom, all the way down, dead cat bounce. When you put it in respect to the actual sell-off, though, it's a dead cat bounce, boom, back down, and we're not actually at the lows yet. It is holding just above the lows, but nevertheless, it looks negative. Right, let's go and take a look at the commods, and then I'll wrap it up, guys. So what's the reaction here? We spoke about the top in oil. So oil took out some important supports. I'll zoom in on those in a second. Yesterday we whipsaw, erratic price activity 2 days ago, Tuesday, Wednesday, then gives up supports and lowering again in the day. Aiming at this hammer low in here. That low there is 111.20 down. That's a real target for today, and down through there would open up risks to 110 and below even today. If we go and look at the 15-minute chart in here, we'd already put in the kind of the topping pattern really already through here. Back in here a couple of days ago with that erratic price action, and then you get a failure even lower, taking out further support to get rid of all this old analysis in here. But that looks really negative. I'm going to zoom out a little bit. That's not particularly, doesn't really show us, but this looks like a much bigger topping pattern for the bigger picture uptrend. Look, so there we'd already triggered it through here with that whipsaw price action we saw back on Tuesday, but then let's reinforce. Now you've got lower lows and lower highs. We're making new lows as we speak. Yeah, so this looks really negative. There's that 111.20 level. That's your short-term target. I'd want to be short that, definitely. Let's take a look at gold. So gold did rebound yesterday. Remember, there's kind of a positive correlation between gold and stocks at the moment. That's because there's an inverse correlation between gold and the dollar, and an inverse correlation between gold and the dollar and as a safe haven, and the riskier assets, the equity indices. So two negative correlations are back add up to a positive correlation. So gold did look like it put a base in yesterday with the rally and giving a lot of that up already today. Zooming in on the 15-minute, again, it looks like a base goes in here. Then we get the whipsaw action in here. Looks like the base goes in, and then yesterday we push up in here into the close post Fed. So there's the Fed in here. I think where's Fed? Here's the Fed, here the rally, and then whipsaw into the close, and then it's given up a lot of that. So not as negative as gold, though. I mean, you can cling, just held onto that low there. That low gold, 1825.7. We held that low in here. Whilst above there, you can venture shorts. You could say this base is still intact. It's a better base than we're seeing on the equity indices. But if the equities go south, this is almost certainly going south again. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Stay safe out there. Helmets and goggles on. It's going to be one of those again. Trade the micros if you need to trade the micros. There's plenty of price action. There's plenty of volatility to give you decent profit. And I'll be back with you with another Bull versus Bear webinar for tomorrow's TGI. Thank God it's Friday. Bull versus Bear webinar. Bye.